Sandeep Tandon joins us now, and what's an incredible run it's been for him also. I mean, from a brokerage to a unknown mutual fund which entered into a competitive market just before COVID and now is enjoying assets which are worth nearly 1 lakh crore. So we are celebrating Teachers Day, and we are celebrating Teachers Day with great learnings of Rakesh Junwala and Warren Buffett. What has been your great learning from the masters of the world, and what would you like to share as a learning for our viewers today on Teachers Day?
See, I think, Nikunj, if you sit down, whether you talk about Warren Buffett or talk about Bhaiya or anybody who's very successful in the market, I think I have always seen the one aspect is the humility aspect. The humility level is next level. And second thing, they always accepted, even on the multiple public forum, the mistake which you did. And we believe that if you can highlight that you have learned from mistakes, okay? And I think that is the biggest learning. Like even at Quant, what we try to say that as a human being will make new mistake. The whole idea is that if we don't repeat our mistake, that's the reason we build our system and process around that. So learning from mistake is something very important, and we have to keep on acknowledging it that yes, as a human being, we have made mistakes and we will make mistakes. So there is no point. The day you get that feeling you have arrived, the problem starts. So the key message for is that keep analyzing yourself, analyzing your mistakes, and then you have willpower to learn from that and rectify that. That is the important learning I have seen from most of the veterans people.
Sandeep, I'm very curious to know what's been your learning in the last 3 to 4 months, and especially when it comes to your conviction on PSUs. Some of those, of course, have fallen from their yearly highs or lifetime highs. Has there been any learning in that process?
See, first of all, you have to understand, when we talk about a very dynamic style of money management, when we say we live in a very dynamic world, where money management style cannot be stepped. Just to give you perspective, if you notice our last 3 months portfolio, actually PSU has come down significantly. Okay. So which clearly means that we have changed and reconstructed our portfolio based on the prevailing environment. We always say it is very important to understand from a risk perspective what is the adaptive asset allocation thesis showing, what sort of environment is prevailing, and then accordingly you can adapt. But we as a house equally remain constructive on PSU or value as a thesis for a longer term perspective. Currently, our portfolio also we have pruned down PSU banks. We have hardly any PSU banks. We have cut down railway exposure. But we are not negative. Sometimes we are running a very mild risk of period globally, which we have been saying from July to September will be the most challenging quarter for this year, because we expect global volatility will spike. And we have seen one round of trailer in the month of first week of August. I will not rule out something similar. Volatility can come back in the month of September. So this is what our analytics is showing. And if data points are showing is mild risk off, then I will reconstruct and rebuild my portfolio, rebalance my portfolio accordingly. And this is what we have done. If you really look at our portfolio, it's more skewed towards insurance sector or healthcare or pharma or FMCG or consumption names, or maybe energy, the only theme which we have in the past continues to maintain as it is. So we are a very agile portfolio manager who will change with the prevailing data. So we are slave of data. So something has already changed and we have implemented that.
Change according to you, and what is the data indicating in terms of is the long-term bull market in PSUs over?
Oh, long-term bull market in PSU is not over. See, we are very clearly, let's talk about India, then we come to PSU, because a large weightage of the Indian economy is linked with the PSU itself. So first of all, we are very clearly always said that we are in decisive bull run. Maybe this decade belongs to us, half century belongs to us. But you have to keep in mind that easy phase of bull run is over. But we are still in bull run and we are in difficult phase. This is a standard statement I generally give perspective to explain. Within the same logic, now get extended to other space. Let's say globally, we believe value as a thesis will be a biggest outlier, and Japan is the biggest value theme which has played out. And what is very important to understand that all PSUs are part of value thesis. So we remain constructive if I have a decadal view. But if I have a very short-term view or horizon, when we spotted that is a mild risk off period and I have to reconstruct, I will change. But if market corrects for whatever reason or becomes more volatile, which at least our volatility is very important, and if we do get some opportunity, we will participate in rebuilding these exposure. So from a structure perspective, longer term perspective, we remain very constructive. But from a very near term perspective, we are slightly cautious in this space because given the high beta and we have moved towards low beta.
I also want to talk about, your thoughts on private banks because I think the concern is pretty much out there from regulators to central banks. All of them are flagging concerns regarding, credit growth and how the money is being pushed out to mutual funds and equity markets per se. And your exit of HDFC Bank, was that a bank-specific case or was it because you do sense a slowdown in the entire private banking space right now?
So, if you really analyze our portfolio for last maybe 1 year or so, we have been quite, I will not say bearish, we have been cautious on the banking sector, particularly private sector, because we always believe that derating of the sector has begun globally. Okay. So when we talk about derating from a valuation perspective, because we believe banks are the byproduct of leverage economy, and leverage economy as a concept is going to deteriorate. Okay. And America, US is a very classic example. So multiple data points. Now you look at even India centric, the credit growth has been marginally impacted. If you look at one of the largest public sector bank actually talk about 14-15%. None of the private sector boards talks about this sort of growth coming. So there are challenges on the deposit front. Cost of actions or the cost of credit cost has also moved up. So if you really look at it's a combination, we are from a now valuations are always absolute and relative. On absolute terms, people say obviously it is cheap, but looking at relative to other sectors or relative to the global market, I think the perspective is very different. So neither we are very aggressively bullish nor we are bearish. We think at appropriate opportunity in liquid names like private sector names, if I get opportunity in extreme inflection points, I will be buyer, and extreme inflection points, I will be seller. So they are no more a core holding for us. They are more of a tactical bets which we keep on playing. And HDFC was a classic example of that trade.
When you say that it is time to reduce the beta, what is the thought here?
So Nikunj, from a very near-term perspective, if I look at the risk appetite indicator for the global markets, if I look at some of the liquidity parameters or indicators which we track on a global basis, and even you look at even asset classes, whether this is the base metal or the precious metal or very recently the NYMEX crude or the Bitcoin, multiple data points are endorsing, okay, that something has changed from a very near-term perspective, and that will lead to a volatility. Since we are student of cycle analysts and we have been, I always been very vocal about spotting trends through employed vols data. And that is something, if I look at the cross asset, cross market data globally, and if then I try to connect the dot, we are very clearly seeing that volatility will remain high. It will remain elevated, can spike sharply. We have seen a small trailer again day for yesterday. So I think that background is not very conducive. So that's a strategy. See, it's not like nobody has a god status to give you perspective. This is what is coming and this will happen. Okay, we connect the dot and try to say this is the probability of such thing happening or this event was be on a higher side. This is what we work through our concept of market implied analytics. What market is showcasing, and market implied analytics is showcasing that this period or this current quarter we expect quality to remain elevated. With that background, we don't want to get butchered if something goes wrong. Okay, but we are neither we are negative nor we are too complacent about the market, and hence we have reconstructed our portfolio slightly low beta, more liquid, and if I have to call it, slightly defensive in nature. Instead of sitting on very large cash, except mid and small, we don't have very large cash. Except mid and small, definitely we felt some amount of opportunity can come at later stage, so we have kept that cash. Otherwise, how to play one opportunity? If you turn very cautious, you raise large cash. Then it's a one thing. Other way of that, play safety. So we are playing with a more from a safety perspective. Let's this phase get over. If data point get changed, which we expect should happen, and as when we get that those indication, we will move towards high beta names. This is what exactly we did in January 2023 when we talked about the risk off period, and we said September, October. We said it's again massive risk on period, and we played that cycle for nearly 6-7 months quite well. So it's not necessary that you have to be aggressive all the time. I think depending on the environment, we reconstruct and rebalance our portfolio.
What about inflows, Sandeep? The concern a lot of market men have flagged off is that look, flows are going into small and mid cap stocks, and as a result, these stocks are getting bidded higher on a daily basis. Is that a genuine concern? And at Quant also, if you're getting flows into mutual funds, especially small and mid cap, how are you planning to invest it now?
See, first of all, Nikunj, if you really sit down and analyze very minutely, in last 3 months, actually in the larger category, whether it's large, mid, or small, or the popular category, including flexi, I think the momentum of flow has been reduced. Why you are not able to see it? Because the maximum amount of flow has come in the thematic side in last, let's say, 3 months in particular. So that's the reason when you look at total flows, this looks extremely on higher side. And I think I have also have concern when these thematic funds get extraordinary allocations and then they're able to push some of the very select names in the market is also from a behavior perspective, we think is a signs of alarming sort of situation. If you look at the rush which we have seen of late in our own industry towards defense sector, a very thematic fund came out, a lot of manufacturing thing. So all these names, because so much money was chasing these limited names, the valuation has gone to the roof. And that gives us discomfort. Now, one way, since we are always say we are student of risk, we in the business of risk management, returns are byproduct, we have to rebalance and reduce the risk. So with that background, I think sector rotation themes should play out very well. So we have cut down, let's say, a defense completely from portfolio, hardly any defense name, one or two names, small, maybe 2-3% exposure we might left with the defense in our overall portfolio, we have cut down. We have pruned down capital goods significantly because where we saw some amount of hype getting built and valuation was slightly stretched. So if you look at your data points, then obviously we have to rebalance. But that does not mean that we have turned negative on the market and we are only saying this phase can be volatile. And if this phase can be volatile, then how will you protect this phase? So with that background, the approach is to play safe. And even you underperform in that phase. It's a part of a strategy we have to play out. Okay, it's not necessary that if environment is not giving you that conviction, you need not to be aggressive at that point of time. Right now, sometimes defensive portfolio is also good. So our whole approach is to generate returns, yes, to generate superior risk-adjusted returns. So when you see risk data is not in our favor, and again, make it very clear, not from a longer term perspective. This is we are talking about from a quarter perspective. Maybe current quarter gets end of this month. So till that time, we remain cautious. As data point changes, we will rebalance our portfolio. See, shifting from a liquid to illiquid or shifting from low beta to high beta is a very smooth thing. But reverse is not true. It takes months to do that.
So Sandeep, what is it that you're doing right now? You talked about reducing exposure in quite a few spaces. Are you just sitting on cash waiting for it to be deployed, or have you already put it to work?
As I said, we have only large cash predominantly in the mid cap and small caps schemes, or mid cap or small cap centric thematic funds. Those are the areas where we have relatively more cash as compared to what we have seen in the past at our end. But in other things like whether you talk about a flexi or whether you talk about a large cap fund or focus fund, all those things we are largely invested. See, as a house, we always maintain 5-6% cash. Okay, so it's 5-6% cash is not something you should look at because we are opportunist house. When you get opportunity and you don't have cash, so as a strategy, we do always have such level of cash. But beyond that, we are not raising extraordinary cash, but we are playing it safe. Okay, so sometimes playing safe make more sense rather than be getting into skew towards whatever is happening in the market, because there's hardly any impact. I agree, India is much more resilient and India risk appetite is much better than the global market. But I always say, ultimately, the mother of all exchanges, if something goes wrong in US, you do get impact. And we have seen every time in the morning, the gap up or gap down is impact of that. So I like to play safe. It's not like we are very negative in the market. Rather, we are extremely bullish. We say, don't move out from don't cut down your equity exposure, but through sector rotation, stock rotation, or scheme rotation, that's the way to play. But don't exit the market. It's not the way, because it's one of the golden opportunities for India in long term. Our perception analytics data is showcasing that something big has changed for India, and we all should be beneficiary of that sort. So we are not even advising exiting any of the mutual fund or cutting down equity exposure drastically. The only thing is that just play safe till the time data point changes.
You know, Sandeep, one more thing, considering you actually map and study investor behavior as well. The recent study which came out from the regulator SEBI talking about as to how, 50% of IPO investors have actually booked out or sold shares within even 1 week of IPO listing, and 70% of them have booked out in 1 year. What is that telling you?
So I tell you, I'll give you a very small, very simple example. A difference between business and investments. Okay, though everybody call us an investor, and I know every investor in the market say I'm an investor. But for a retail investor who is putting his saving and trying to create wealth out of from long term, they are really investor. For all HNI in family office, I don't consider them investor because that is their business. Okay, so rotation and switching is their part of their business. And if you really look at if you get back into this study and analyze who are the people who have sold. So the people who have booked profit in 1 week's time, 1 month's time, or 3 months' time are predominantly will be the people who have extraordinary wealth or extraordinary investment book which they run. So it's a business perspective, and it's make business sense for them if they keep on churning. And this is what happens globally also. And if you can keep on churning and they get 5%, 8%, 10%, look at the cumulative returns on a yearly basis is extraordinary. So I think you should very clearly differentiate between the investor versus business. So business guy, for them is a business, and they're doing a perfect job for that.
Right. So where is it that you're sensing that kind of opportunity? Maybe not now, but if you see any consolidation or dip in specific stocks in, say, the next 1 to 2 months.
So I think let's me talk about let's say go with the financials, like what we did in our portfolio. We can talk about, it'll give you perspective. We've cut down banks, but we have increased our some exposure in select NBFC because we.
Oh, I seem to have snapped that line.
Okay, so it was.
Okay, Sandeep is back, I think. Yeah, Sandeep, go ahead.
Yeah. So I said some of in the BFSI space, we have cut down exposure in banks completely, but or largely, but we have increased our exposure towards some of the large cap NBFC where we see value as they were trading in the neglected territory for a while. Then we also see opportunity in last 1 quarter. We have built exposure in the insurance sector because that was again traded in the neglected territory. And if the interest rates keeps on and if the expectation can come down, I think they should be further beneficiary. So we trying to identify where under ownership is there and they have been trading in the neglected and the valuations are comfortable. That's the part where I think there's a one area definitely looks good. I think when you talk about consumption as a theme within that FMCG also theme, I think it has more legs. We have seen very initial reaction right now, and if we believe that Rabi crop is also going to be good, the monsoon effect is going to play out on the rural economy. I think that's a consumption as a theme should do very well. Even FMCG should part of that theme should do very well. So that's another area. Look at pharma is again we are in a structure bull run from a pharma perspective. Okay, where IT earnings were impacted in last let's say in 2 years or so, where pharma earnings actually cycles inching up, particularly on the US generic side. Even domestic pharma companies are doing very well. So some of the space, then larger infra is a theme, but when one has to be very selective. And whatever reason, if some of the PSUs which have been the darling of the market correct another 10, 15, 20%, I think that should be another great opportunity will come. It's not like in the entire PSU, everything we have sold off and everything is negative. No, we have shifted exposure towards some of their names. So I think you have to identify some of these opportunity and continue to hold on from a medium to long-term perspective. I think it's a great opportunity.
Right, Sandeep, so good chatting with you, and thanks for taking this request today.
Yeah, thanks a lot.